REG Area IV tests how individual taxpayers report income, deductions, losses, credits, and pass-through items on Form 1040. The main skill is following the individual tax return flow. Identify what is included, excluded, deductible, limited, credited, or disallowed.
Think of every single item you encounter on the exam as a piece of this winding path. Your task isn't just to identify the tax treatment, but to place it at the exact right mile marker on the return. An error at the beginning of this path, well, it compounds all the way to the end. If you misclassify an exclusion as an inclusion, your gross income is wrong, which throws off your adjusted gross income, which then completely miscalculates your allowable itemized deductions, ultimately resulting in an incorrect tax liability. Precision at each and every step is absolutely crucial.
Okay, let's dive into this with Section 1, Area 4, and Return Flow. Area 4 represents a massive 22 to 32% of the REG section blueprint. This area focuses heavily on routine, individual federal tax compliance. We're talking about evaluating gross income, pass-through items, adjustments, and loss limitations, flowing all the way down to filing status, tax, and credits. Mastering this compliance flow is, without a doubt, the highest yield investment of your study time. Because this is one of the largest areas on the REG exam and is so closely tied to Form 1040, your foundational understanding of how these pieces fit together is non-negotiable for a passing score. Every question in this area maps back to the core Form 1040 return flow. First, you start with gross income, immediately pulling out exclusions because, well, they're permanently non-taxable. Next up, you subtract adjustments to arrive at adjusted gross income, or AGI. Now, AGI is a really critical subtotal because it triggers limitations for other deductions down the line. From AGI, you subtract your standard or itemized deductions to reach taxable income. Only then do you calculate the tax itself, apply credits to reduce that tax liability dollar for dollar, and finally determine the payment or refund. Just remember these core rules. Deductions reduce income, credits reduce tax, and limitations defer or disallow losses. Now, as you study, please don't panic over memorizing exact inflation index limits or crazy complex phase-out thresholds. Exam questions generally provide rates, limits, thresholds, and phase-outs when needed. Your job isn't rote memorization of every changing number. Your real job is correctly applying the tax rules to the facts you're given. If the exam provides a phase-out range for a deduction, you just need to know how to calculate the allowed deduction based on the taxpayer's AGI, rather than stressing out trying to memorize the bracket amounts from a textbook.
Moving on to Section 2, Income and Pass-throughs. Let's look at the top of the return flow. Based on the blueprint tasks, you'll see the exam tests your ability to evaluate an item and immediately classify it. Is it included in gross income or is it excluded? That binary decision is your starting block. You've got to look at a transaction, whether it's a stock sale, a fringe benefit, or a damage award, and instantly know if it hits that first line of Form 1040.
Now, what's really interesting about this slide is how we clearly separate taxable items from completely non-taxable exclusions. Say our taxpayer, Sarah, earns $60,000 in W-2 wages, gets a $2,000 bonus, and earns $500 in corporate bond interest. All of that is included in gross income. We also include retirement income, guaranteed payments, punitive damages, and capital gains. Yeah, even gains on virtual currencies. But if Sarah receives a $10,000 cash gift from her grandmother, or maybe $50,000 in life insurance proceeds after a relative passes away, those are exclusions. They bypass gross income entirely. You don't report them as income and then deduct them. They just simply never enter the taxable equation.
Individuals also frequently receive income from pass-throughs, like partnerships, S corporations, LLCs, and disregarded entities. These entities generally don't pay federal income tax themselves. Instead, the tax attributes flow straight through to the owner's personal Form 1040. The absolutely critical distinction here is between ordinary business income and separately stated items. Ordinary business income is just the net result of day-to-day operations, but separately stated items, like a partnership's $5,000 capital gain or a $1,000 charitable contribution, have to be reported separately on the owner's Schedule K-1 and pass through individually to their 1040. Why? Because they trigger specific tax limitations at the individual level. And remember, owners are taxed on this flow-through income whether or not they actually received a single dollar of cash distribution from the business.
All right, Section 3, Deductions and Loss Limitations. This is how we start reducing that gross income. Candidates frequently mix up the two major categories of deductions, so let's get this straight. First, we have adjustments. These are your before AGI deductions. Think retirement plan contributions, health savings account contributions, and self-employment expenses. Second, we have deductions taken from AGI. These are your itemized deductions like qualifying medical expenses, qualified residence interest, state taxes, and casualty losses. Or, of course, a taxpayer might just take the standard deduction instead of itemizing. Then we also have the qualified business income, or QBI deduction, which is a separate individual level deduction applied after AGI. Categorizing these correctly is a real game changer on the exam. If you accidentally put an itemized deduction into the adjustments category, you'll artificially lower AGI and totally throw off all your subsequent calculations. When you're dealing with pass-through business losses, you have to apply the loss limitations in a very strict, specific order. 1. The basis limitation. You literally cannot deduct a loss beyond your tax basis in the entity. If your basis hits 0, the loss stops there. 2. The at-risk limitation. You must actually be at economic risk for the loss amount, meaning you aren't somehow protected against the loss by non-recourse financing. 3. The passive activity limitation. Passive losses can generally only offset passive income, not your active W-2 wages or portfolio income. So before you deduct any business loss on an exam question, you must ask yourself, is this loss currently allowed? Is it limited? Is it deferred to a future year? Or is it just completely disallowed? Beyond pass-through losses, you also have to navigate specific disallowed and limited losses. For example, net capital losses are limited to a $3,000 deduction per year against ordinary income for individuals, with the rest carried forward indefinitely. Other losses are entirely disallowed, meaning they will never, ever reduce taxable income. We're talking about hobby losses, losses on wash sales, where you repurchase substantially identical stock within 30 days, and losses on the sale of personal use assets. If a taxpayer sells their personal car or living room couch at a loss, it's completely ignored for tax purposes. No way around it, you cannot deduct it. Next up, Section 4, Filing Status, Tax and Credits. We've made it to the bottom of the return flow. So the crucial point is how you convert that taxable income into a final tax liability. Accurately determining filing status and identifying dependents dictates the tax brackets and the standard deduction applied. Whether someone is single, head of household, or married filing jointly dramatically shifts the math. Once you compute the tax based on that income, you apply your credits. You absolutely must know the difference here. Non-refundable credits can reduce the tax down to 0 but not a penny further, whereas refundable credits can actually trigger a refund check from the IRS, even if your tax liability drops below 0. Also, be sure you know the estimated tax safe harbor requirements to avoid underpayment penalties and understand at a high level when the net investment income tax kicks in for high-earning taxpayers. Section 5, TBS Angle, Form 1040. Let's talk about practical application. In a task-based simulation, you're going to be reviewing a draft tax return alongside supporting documents, things like W-2s, K-1s, and client emails. You are essentially hunting for specific errors made by a junior preparer. Spot missing income, like an unreported guaranteed payment hiding in a partnership agreement. Catch wrong exclusions, like a preparer mistakenly taxing municipal bond interest, which, of course, should be tax-free. Watch out for deduction category errors, like putting an adjustment down into itemized deductions. And keep a sharp eye out for loss limitation violations, like trying to offset active W-2 wages with a passive rental real estate loss without meeting a specific exception. You've got to tie the source document to the correct line on the 1040. Finally, Section 6, Framework and Common Traps. This is how you pull it all together on exam day. Here is your rapid-fire framework. Every time you read a multiple-choice question or open up a TBS, ask yourself, who is the taxpayer? What specific item is being tested? Immediately classify it. Is this an inclusion, an exclusion, a deduction, a credit, or a limited loss? Where exactly does it fit in the Form 1040 flow? Is it up top impacting gross income, in the middle adjusting AGI, or at the very bottom reducing tax? Do strict basis or loss sequence limitations apply to it? And finally, what is the ultimate impact on taxable income or the actual tax due? Following this structured thinking guarantees you won't get lost in the weeds of a complex scenario with multiple tax forms. And you've got to avoid these common examiner traps. Do not treat a tax-free exclusion as a deduction that reduces other income. Exclusions simply never enter gross income in the first place. Do not treat a dollar-for-dollar credit like a mere deduction from income. Credits are so much more powerful because they reduce the tax liability directly. Don't forget that a lot of itemized deductions are limited by AGI thresholds. Never ignore the character of separately stated pass-through items. Never, ever deduct a business loss without checking your basis and at-risk limits first. Don't confuse a realized gain with a recognized taxable gain. And finally, please don't waste precious study time memorizing exact index thresholds instead of focusing on applying the core facts provided in the prompt. Area IV is an individual return flow area.
First, identify the item, then decide whether it is included, excluded, deducted, credited, limited, or disallowed, and place it correctly in the Form 1040 flow.